The silver market has just experienced one of its most dramatic collapses in modern history, and the fallout is creating international tensions that go far beyond simple market mechanics. On February 10, 2026, the United States Treasury Secretary stood before the financial world and delivered a controversial statement that has sent shockwaves through global markets. The extreme volatility witnessed in precious metals over the past 2 weeks has been characterized as a speculative blow-off, with the finger pointed directly at what officials are calling unruly trading activities originating from China. Before we dive deep into this explosive controversy, if you find this analysis valuable, please hit that like button, share this video with anyone interested in precious metals markets, and drop a comment below with your thoughts on whether this narrative holds water. Your engagement helps us bring you more critical market analysis like this, so let's jump right into what's really happening in the silver market. To understand the magnitude of what we're witnessing, we need to look at the numbers. Silver is currently trading at $82.58 per ounce as of February 11th, 2026. This represents a stunning 2.24% gain from the previous day and an extraordinary 155.84% increase compared to where we were just 1 year ago. But these numbers only tell part of the story. Just 2 weeks ago, on January 29th, silver reached an all-time high of $121.67 per ounce. Then came the crash. On January 31st, silver plummeted 31.4% in a single day, marking the worst decline since March 1980. From peak to current levels, silver has shed approximately 32% of its value in less than 2 weeks. The Treasury Secretary's comments specifically highlighted a particular investment vehicle that has become emblematic of the speculation narrative. The UBS SDIC Silver Futures Fund in China had been trading at a staggering 36% premium over its net asset value before emergency suspensions were enacted. To put this in perspective, when an investment fund trades at a 36% premium to what its underlying holdings are actually worth, it signals extreme speculative fervor. Investors were so desperate to gain exposure to silver that they were willing to pay 36% more than the actual value of the silver the fund held. This kind of premium is virtually unheard of in normal market conditions and speaks to a frenzy that had gripped Chinese retail investors. The political dimension of these accusations cannot be understated. By explicitly blaming Chinese speculators for what's being termed unruly market behavior, American officials are signaling deep discomfort with China's growing dominance over precious metals, refining and trading infrastructure. The concentration of silver refining capacity in China has been called a single point of failure for the global economy. This isn't just about one volatile week in the markets. This represents a fundamental geopolitical concern about who controls the infrastructure that processes and trades strategic commodities. But let's examine what actually happened during those chaotic days in late January. Between Trump's inauguration and the end of January, silver prices rose nearly fourfold. This wasn't a gradual climb. This was a parabolic surge that defied traditional market logic. The initial trigger came from reports about a new Federal Reserve chair nomination. When news broke about Kevin Warsh potentially being nominated as Fed chair, it appeared to relieve some market concerns about central bank independence, and the dollar soared. A stronger dollar typically puts downward pressure on dollar-denominated commodities like silver. However, the underlying dynamics were far more complex than a simple currency move. In the week leading up to the crash, both the CME Group and Shanghai Futures Exchange raised margin requirements on precious metals futures. The CME increased requirements twice within a single week. When exchanges raise margin requirements, it means traders need to put up more cash to maintain their positions. For leveraged speculators, this creates an immediate liquidity crunch. Many investors who had piled into metals with borrowed money suddenly faced margin calls, forcing them to sell positions regardless of their long-term outlook. The physical silver market was showing signs of extreme stress even before the price collapse. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery in just 7 days. This represented roughly 26% of registered inventory disappearing in a single week. Think about that for a moment. More than a quarter of available silver that was supposed to back futures contracts simply vanished from the exchange in 7 days. This kind of drainage is unprecedented and suggests that someone, or many someones, were demanding physical delivery rather than accepting cash settlement. The disconnect between paper silver and physical silver had reached absurd levels. The notional ratio of paper silver to physical silver reached as high as 356 to 1. This means that for every single ounce of actual physical silver, there were 356 paper claims on that ounce. In a normal functioning market, most futures contracts are closed out or rolled forward before delivery. But when a significant number of participants start demanding physical delivery simultaneously, the system breaks down. 1-month silver lease rates, which typically hover around 0.3 to 0.5%, exploded to around 8% by January. Lease rates represent the cost of borrowing physical silver. When they spike to 8%, it signals a desperate shortage of available metal. Chinese analysts have pushed back hard against the narrative that their traders caused the volatility. They argue that the fundamental driver lies in American dollar dynamics and Federal Reserve policy uncertainty, not speculation from Chinese retail investors. There's compelling evidence to support this counter-narrative. Major investment banks have pointed out that the timing of the most violent price swings occurred while Chinese futures markets were closed. If Chinese speculation was truly the primary driver, why would the biggest moves happen when Chinese traders couldn't even access their markets? This suggests that Western institutional flows, not Chinese retail speculation, were behind much of the buildup and subsequent unwind. The geopolitical implications extend beyond finger-pointing. China implemented new silver export controls starting January 1st, 2026. These controls require exporters to obtain licenses from the Ministry of Commerce, and the rules are expected to remain in place through 2027. The licensing framework is expected to restrict 60 to 70% of global silver supply to domestic use. Only large, state-certified companies that produce at least 80 tons of silver annually will be granted export licenses. China is the world's second-largest silver producer, having produced 3,300 metric tons in 2024. This move isn't happening in isolation. China has previously implemented similar restrictions on rare earths, tungsten, and antimony. The pattern is clear. China is securing domestic supply chains for materials it deems strategically important, particularly those needed for green technology, electric vehicles, and advanced electronics. The timing of these export restrictions, combined with the price volatility, creates a perfect storm of supply concerns and geopolitical tension. The silver market was already in its 6th consecutive year of structural deficit before this volatility erupted. The accumulated deficit between 2021 and 2025 is estimated at about 900 million ounces. In 2026, the market is expected to remain in deficit by 67 million ounces, according to official projections. When you factor in China's export restrictions potentially removing another 200 million ounces from the global market, the effective deficit could be much larger. These aren't speculative numbers. These come from industry organizations tracking physical supply and demand. COMEX registered inventories in the United States are down nearly 70% since 2020. The London Bullion Market Association vaults have lost around 40% of their holdings. Where has all this silver gone? Some has moved into investment products. Silver-backed exchange-traded funds absorbed almost 150 million ounces in 2025 alone, with total ETF holdings reaching 864 million ounces by the end of December. But even more has been consumed by industrial applications that literally destroy the silver, preventing it from being recycled back into the market. Industrial demand now accounts for more than half of total silver consumption, up 50% since 2015. Solar panels are the single biggest industrial user. Every solar panel needs about 0.64 ounces of silver, and hundreds of millions of panels are being installed annually. Global solar capacity is forecast to reach 665 gigawatts in 2026, supporting around 120 to 125 million ounces of silver demand from solar alone. Electric vehicles use twice as much silver as gas-powered cars, about 1.3 ounces each. The semiconductor industry, driven by the artificial intelligence revolution, is expected to consume 23 million ounces by 2030. This creates a fundamental problem for those who want to characterize silver's rise as purely speculative. Yes, there was speculation. Yes, leverage amplified the moves. Yes, retail investors in China and elsewhere piled in hoping for quick profits. But underneath all that speculation lies a genuine structural supply-demand imbalance that isn't going away. When industrial users need silver for solar panels or electric vehicles, they can't simply decide not to use it because the price went up. There are few viable substitutes for silver's unique properties in many applications. The accusations from the Treasury Secretary serve multiple purposes beyond simply explaining market volatility. First, they shift responsibility away from American policy uncertainty. The period of extreme silver volatility coincided with questions about Federal Reserve independence, concerns about trade policy, and broader uncertainty about economic direction. By blaming Chinese speculators, American officials can avoid uncomfortable questions about whether their own policy uncertainty contributed to investors fleeing into hard assets. Second, these accusations lay groundwork for potential regulatory action. If Chinese speculation is framed as destabilizing global commodity markets, it provides justification for restrictions on cross-border commodity trading or new oversight of foreign participation in American futures exchanges. Third, and perhaps most importantly, this narrative reinforces the broader geopolitical competition over strategic resources. Silver isn't just a precious metal for jewelry or investment. It's a critical material for the energy transition, for advanced electronics, for military applications, and for the technological infrastructure of the 21st century. By characterizing China's role in silver markets as problematic, American officials are highlighting the vulnerability created by depending on Chinese refining capacity and supply chains. Safe haven demand has been fueled by rotation away from dollar-denominated assets amid growing concerns over policy uncertainties. Between Trump's inauguration and the end of January, this safe haven demand helped quadruple silver prices. Elevated geopolitical tensions, concerns over Federal Reserve independence, and persistent policy uncertainty have continued to support precious metals investment even after the crash. The question is whether these fundamental drivers of investment demand remain intact or whether the spectacular crash has permanently damaged silver's safe haven appeal. European silver exchange-traded products saw 644.4 million euros of outflows in the first week of February. This represents a dramatic reversal from the record inflows seen throughout 2025. Investors who rode silver's 132% rally in 2025 are now either taking profits or cutting losses after the historic sell-off. However, global silver ETP holdings still stand at an estimated 1.31 billion ounces as of February 9th. Suggesting that while European investors are fleeing, American and Asian investors may be holding their positions. This geographic divergence in sentiment reveals different risk appetites and investment horizons across regions. The volatility has created a unique situation where silver is trading at different prices in different markets. In Shanghai, physical silver is trading above $80 per ounce, while paper-traded silver futures show different levels, creating unusual arbitrage opportunities. When physical metal trades at a premium to paper contracts, it signals that market participants trust tangible metal more than promises to deliver metal in the future. This disconnect between physical and paper markets is precisely what caused the late January chaos. Allegations emerged about major financial institutions closing huge short positions at the exact intraday bottom of the crash. The London Metal Exchange went dark, and major bank systems went offline on the same day as the worst of the selling. Whether these were coincidences, technical glitches, or something more coordinated remains a subject of intense debate. What's undeniable is that these events contributed to a loss of confidence in the orderly functioning of silver markets. Market watchers have drawn comparisons to meme stocks like GameStop, warning that silver prices had become detached from sustainable levels. This characterization has gained traction in financial media. However, unlike GameStop, which was a struggling retail chain with limited fundamental value, silver has real structural fundamentals supporting higher prices. The meme label may be unfair, but it reveals how speculative fervor amplified an already tight market into a full-blown squeeze, followed by an equally dramatic unwind. The silver-to-gold ratio currently stands at 61.2, near the lower end of its multi-year range. Historically, this ratio has averaged around 60 to 70 ounces of silver to 1 ounce of gold. When silver strengthens relative to gold, pushing the ratio below 60, it typically signals either that silver is outperforming on its own merits or that it's becoming overvalued relative to gold. The current ratio, even after the crash, shows silver maintaining relative strength compared to its historical relationship with gold. High silver prices are driving innovation to use less silver per application. Solar manufacturers have placed an even greater emphasis on thrifting, especially with silver prices rising. A key advancement has been the development of copper-cored silver paste, which has seen rapid evolution since the introduction of heterojunction photovoltaic cells in late 2022. While global solar installations are expected to continue rising in 2026, ongoing thrifting and outright substitution away from silver will result in photovoltaic silver demand declining by approximately 5% year over year despite record solar panel installations. This creates a paradox. High silver prices are simultaneously driving innovation to use less silver, making silver-dependent technologies more expensive and encouraging substitution efforts across industries. Yet total demand remains structurally higher than supply due to expanding use cases in electric vehicles, artificial intelligence data centers, fifth-generation wireless infrastructure, and continued solar growth despite efficiency improvements. Research examining global silver requirements indicates that by 2030, supply may meet only 62 to 70% of demand. The Treasury Secretary's accusations have added a new layer of complexity to an already complicated market. Whether Chinese speculation was truly the primary driver of volatility, or whether it's a convenient political narrative, the underlying reality remains unchanged. The silver market faces a structural deficit. China controls critical refining capacity and has restricted exports. Industrial demand continues to grow even as manufacturers try to use less silver per application. Investment demand surged on safe haven flows and concerns about monetary policy. All of these factors created conditions ripe for volatility. The question now is what happens next. Will prices stabilize around current levels near $80, or will we see another leg down as more leveraged positions are unwound? Will Chinese export restrictions lead to sustained supply shortages, or will other producers ramp up output to fill the gap? Will industrial users successfully reduce their silver consumption through technological innovation, or will growing applications offset efficiency gains? Will the geopolitical tensions between the United States and China over strategic commodities escalate, or will cooler heads prevail? One thing is certain. The silver market will remain volatile. The combination of tight physical supplies, large paper positions, geopolitical competition, and genuine industrial demand creates conditions where price swings of 10 or 20% in short periods should be expected rather than surprising. For investors, this means both opportunity and risk. For industrial users, it means uncertainty in input costs and continued pressure to find alternatives. For policymakers, it means navigating the treacherous waters of resource nationalism and supply chain security. The blame game between American officials and Chinese traders obscures a more fundamental truth. The global commodity markets that emerged in the post-World War II era assumed abundant supplies, free trade, and minimal geopolitical interference. Those assumptions no longer hold. Whether it's silver, rare earths, lithium, cobalt, or any other strategic material, the era of taking reliable global supply chains for granted has ended. Nations are increasingly viewing these materials through the lens of national security rather than pure economics. Silver sits at the intersection of multiple megatrends. The energy transition requires massive amounts of silver for solar panels. The electrification of transport needs silver for vehicle electronics. The artificial intelligence revolution demands silver for advanced semiconductors. The rollout of next-generation wireless networks uses silver in countless components. At the same time, monetary uncertainty drives investment demand. Currency debasement concerns push investors toward tangible assets. Geopolitical tensions create safe haven flows. All of these trends were present before the January volatility, and all remain in place today. The crash may have shaken out some speculators, but it hasn't resolved the underlying supply-demand imbalance. If anything, by highlighting the fragility of silver markets and the geopolitical tensions around strategic materials, the volatility may have reinforced the long-term investment thesis, even as it punished short-term traders. Markets rarely move in straight lines, and silver has certainly proven that rule over the past month. Industrial fabrication is forecast to decline by 2% in 2026 to around 650 million ounces, with weakness underpinned by developments in the photovoltaic sector. However, this modest decline in industrial demand doesn't address the core problem. Even reduced demand significantly exceeds available supply when you account for Chinese export restrictions and depleted inventories. The market will remain in deficit for the 6th consecutive year, forcing continued drawdowns of above-ground inventories. Looking at the bigger picture, the Treasury Secretary's comments reveal a growing awareness among American policymakers that dependence on Chinese-dominated supply chains for strategic materials represents a national security vulnerability. This awareness extends far beyond silver to encompass the entire suite of materials needed for advanced technology, clean energy, and defense applications. The accusations about Chinese speculation in silver markets are really about this larger strategic competition. For those watching these markets closely, the lesson is clear. Volatility is the new normal. The days of gently trending commodity prices responding predictably to supply and demand fundamentals are over. Geopolitical considerations now override traditional market forces. A tweet from a political leader, an export restriction announcement, or a regulatory change can move prices more than years of gradual supply-demand shifts. This creates both challenges and opportunities for those willing to accept the risks. Thank you for watching this deep dive into the Treasury Secretary controversy and the silver market chaos. In our next video, we'll be analyzing the 5 most likely scenarios for where silver prices go from here, including specific price targets for each scenario and the catalysts that could trigger them. We'll examine the technical charts, the seasonal patterns, and the fundamental drivers that will determine whether we've seen the bottom or if more downside lies. Ahead, make sure to subscribe and hit the notification bell so you don't miss that critical analysis. Excited? The silver story is far from over, and understanding what comes next could make the difference between profit and loss in these turbulent markets. Subscribe now and I'll see you in the next video.